Okay, well, thanks for staying here. My name is Rodrigo Caputo. I'm from the Central Bank of Chile, and this is a paper about Chile, of course. It's a history of Chile since the 60s to 2010, and it's a co-author paper with Diego Sarabia, which is also from the Central Bank of Chile, and is here. Okay, so the motivation is the following. Chile, as many Latin American countries, experienced economic and political transformations in this period, and in particular, in the early 70s, we experienced the only hyperinflation episodes we have had in the history of the Republic of Chile. Okay, this was a short period. Hyperinflation lasted 2 years, basically, and then inflation declined. Okay. Then, in the early 80s, there was a severe balance of payment crisis, and in both cases, the 70s hyperinflation and in the 80s balance of payment crisis, the real costs were very important, okay? Since 1990, positive rates of growth and declining inflation. As Marcio was mentioning, Chile recovered democracy in the 90s, okay? So, but before democracy, we began to have positive rates of growth, GDP growth, and declining inflation in the mid-80s, okay? And that has lasted until today. So in that context, the purpose of this paper is to understand the role of monetary, fiscal, and debt management policies in determining the macroeconomic outcomes of Chile in each case, in each period of time. Okay? So to give you some perspective in terms of economic and political events, we should mention that nominal and real volatility was present in different periods of time, okay? In this period, there were 7 democratically elected governments with a period which was 17 years of an authoritarian regime, okay? So for instance, from 60 to 64, there was a right-wing president, Alessandri, then Frei Montalva from 64 to 70, a short period of socialist president, 70 to 73, Allende, then Pinochet from 73 to 1990, and we distinguish 2 periods, okay, Pinochet 1 and Pinochet 2, which basically, as you will see, are characterized by 2 different approaches to stabilizing inflation and the management of monetary policy, okay? Then in 1990, democracy was recovered, and the first president, Elwin, from 1990 to 1994, Frei Ruiz-Tagle, from 94 to 2000, Lagos from 2000 to 2006, and Bachelet from 2006 and 2010, okay? And as I was mentioning, output growth, importantly, since the mid-80s, okay? And now it's a bit, I mean, today it's a bit higher than this value, is 4%, 5%, and inflation has been declining systematically since the mid-80s, okay? Now inflation is below 3%, okay? But this is somehow a recent phenomena. At the beginning of the 70s, inflation was high. Then during Allende's time was even higher, and this is the hyperinflation period we experienced. And then during Pinochet time, the first part of the dictatorship, inflation was still very high, okay? So we will discuss 3 different periods that characterize the Chilean economy. Of course, there can be many more, but we think those periods can be seen as periods in which some types of systematic policies were adopted, okay? And those periods overlap with political ruling, okay? So in different periods, we have sometimes democratic governments that overlap with dictatorship and so on, okay? Because there was some continuation of policies in some times. So the higher nominal volatility that Chile faced in the past was in the 70s, okay? Since the 60s to 73, but especially during Allende's presidency, okay? And this was, we believe, and we show that this was caused by fiscal deficits that were prevailing at that time, okay? In 74 to 87, Pinochet Pinochet regime faces first the challenge of stabilizing the economy, and then after the stabilization of the economy, through exchange rate policies was reached, there was a severe balance of payment crisis at the beginning of the 80s, okay? So the way out to this crisis was somehow designed by Pinochet's economists, but was continued even in democracy, okay? In the 90s, we can characterize a period in which there was fiscal discipline, a fiscal rule, an explicit fiscal rule, and then explicit inflation targeting. This was done under democracy, okay? So this is the plan of the paper. We will discuss each of these periods at a time, trying to highlight the main policies that were undertaken in each moment, okay? Okay, the 60s. 1960 to 1973. Inflation was a problem in the 60s. Here, given the scale of the graph, it's not evident, but those levels of inflation here are 30, 40%, even more, okay? At the beginning of the 60s, Alessandri tried to stabilize inflation, and actually inflation reached single-digit levels, but then fiscal deficits prevailed and inflation returned to high levels, okay? At the beginning of the 70s, inflation was high, but then from 71 to 74, 75, and until 78, inflation was very high, okay? And once we plot the rate of growth of money, we can see that perhaps if you see the rate of growth of money, the rate of inflation that we experience is not very surprising, okay? So it's a strong correlation between the rate of growth of money and inflation in this period. At the beginning, this part here is the first year of Allende's presidency, and inflation didn't increase too much. Some authors argue that this perhaps is due to the fact that there was price control at that time, so prices couldn't increase, okay? From then on, however, inflation began to rise to important levels. The inflation problem was not only during Allende's presidency, okay? It continues until the first part of the military regime, okay? So from 74 to 78, inflation was still very high. There was no evident way in which this could be stopped, okay? And we will discuss what are our interpretation of this period. From the 80s to today, inflation has declined substantially, okay? And it's not a problem anymore as before. Okay, so to try to understand why inflation was a problem and what was the cause of inflation during the first period, we revisit the budget constraint of the government, which is this expression here, that says that, well, public deficits have to, interest rate payments have to be financed either by nominal debt, money, indexed debt, or foreign debt, okay? And in terms of first differences, this equation looks like this, okay? So the deficit plus interest rate payments, gross interest rate payments, have to be financed either with senior edge or with new debt, foreign debt, indexed debt, or nominal debt, okay? So this is the identity that, this is the budget constraint of the government. So we will try to see each of these components during the 70s and also into the 2000s, and to try to see what are the main determinants of either movements in senior edge or movements in other variables, okay? And the first component of this identity we will try to see is the public deficits, okay? And they, in fact, increase from 8.1% of GDP in 71, which is the first year of Allende's presidency, to a very high level, which is to 23% of GDP in 1973, okay? So Allende was a socialist president. He had a very aggressive expanding plans, okay, trying to improve conditions of the working class and so on. And that's the reason why spending grew much more than taxation, okay? And to see, well, foreign lending, actually, during Allende's time, actually, once you correct for the real exchange rate, actually declined, okay? So, and this is not surprising. Allende had a very aggressive policies, I would say, against foreign investments. Allende's nationalized basically the copper industries, and many private industries were nationalized as well. So there was no access to foreign markets, and this is not very surprising. So the foreign lending actually declined during Allende's time. Okay, you then see a sharp recovery during Pinochet's era. Domestic lending, domestic debt to the government in nominal terms actually increased a lot, but once you compare this value to the public deficit value, you will see clearly that it doesn't compensate the increase in the deficit. So perhaps the obvious answer is to the question, what is the way in which you finance this public deficit of this magnitude? Well, this is the answer, we think. Okay? So senior edge actually increased substantially. And it went in 73 to, it was 16, 17% of GDP, and then it gradually declined, but it was, in the 70s, it was an important source of public funds, okay? So senior edge actually, as everyone expected, declined for high values of inflation, okay? So you see that in 73, it was 16% of GDP with an inflation, annual inflation of 300%. In 74, inflation increases even more. The interpretation for this is that in 73, there was a repressed inflation, and the military actually liberate inflation, or they didn't control prices anymore, so inflation spiked. But at that time, with 600% inflation, actually senior edge actually declined to 8% of GDP. And inflation continued to be high until 77, 78, and the senior edge as a percentage of GDP declined systematically. So how those figures looked when we plot them together? Well, we see that from this 1973 to 1974, 75, inflation was actually perhaps on the right-hand side of the Laffer curve. Okay, so perhaps in 73 and 74, 75 is going to be here. Inflation was on the right-hand side of the Laffer curve. Okay, so there was no way of collecting additional senior edge by raising inflation. We couldn't resist the temptation of doing this exercise. Okay, so we have monthly data on inflation and on real balances. Okay, so to see the extent, or try to calculate the level of inflation that maximizes senior edge, we estimate this simple model, Kagan 1956 model, in which real balances in hyperinflations depend basically on expected inflation. Okay, and as shown by Philatkits and Taylor in 1993, if real balances and inflation are I1, and if they cointegrate, it is possible to estimate this relationship here, where instead of having expected inflation, you can replace it by actual inflation, contemporaneous inflation. Okay. And why do we do this? The reason is that the estimate of alpha, the inverse of alpha, will give you the rate of inflation that maximizes senior edge. Okay. So our estimate from 1971 to 1980, alpha is 10 basically, and according to this result, the level of inflation that maximizes senior edge is 1/10, which is 10% in monthly terms, and this implies an inflation of 221% in annual terms. Okay. So not surprisingly, this alternative exercise gives an inflation rate that maximizes senior edge in this range here, which is actually a level of inflation which is between the level of inflation experienced between 1972 and 1973. So to summarize, we can see, we can see that between 71 and 73, there was a high level of nominal volatility induced perhaps by increased financial fiscal deficits in that era. Okay. Inflation, however, after 73, after the military took power, was very persistent and didn't came back to the previous level very easily. Okay. In April 74, inflation rate measured as year-on-year variation increased to more than 700%. Okay. And one potential reason many people discuss is that price controls were removed after 73, after September 73. Okay. So once price controls are removed, price could perhaps adjust to the new levels. Okay. However, inflation declined after 74, but very slowly. Okay. And this, despite the fact that fiscal deficit actually declined quite substantially. Okay. So in 73, the fiscal deficit was close to 23% of GDP. In 74, it was 7%, and then it reaches levels close to 0. So somehow this is a puzzle. Okay, you have a fiscal deficit that declined substantially. Seniorage is still at high levels, and so is inflation. Okay. Between 74 and 1980, seniorage was larger than public deficit. Okay, and the question, which we think is relevant, is why inflation could not be stopped. Okay, accepted hypothesis in Chile or among Chilean economists is that, as the case of Brazil and other countries, perhaps wage indexation played an important role. Okay, so wage indexation to past inflation may have something to do with this persistent inflation. Plus, there was some government reluctance to do an abrupt adjustment. Okay, so the militaries who were in charge of the economics at that time were very puzzled as to what to do with inflation. Okay, so there were some views that were the views that prevailed at that time, that it would be very costly to adjust inflation very abruptly. So they decided to do it more slowly. Okay, so that's perhaps the view or the accepted hypothesis in Chile. What are the alternative hypotheses that, well, we have to be tested, we want to test them, is that perhaps additional funds were needed and not were reflected in the public deficits that were available. Okay, so an alternative is that there were some additional expenditures, like expenditures you have to use to reduce deficits, okay, or to pay interest rates that are not reflected in this public deficit. We have to work on this hypothesis, but it's an additional hypothesis we want to test. At the same time, in 1975, Chile was experiencing a severe crisis, and perhaps one response to that crisis was to have a lax monetary policy in the face of adverse events. Okay. So how the militaries actually stabilized the economy? Well, they adopted in June 1971 a fixed exchange rate regime. Okay. Inflation at that time was still very high, and wages and some other financial contracts were still indexed to past inflation. Okay. In 1981, inflation declined to single-digit levels, 9.5%, and there was a consensus, or there is a consensus, that this high level of indexation plus a fixed exchange rate will induced a real exchange rate appreciation at that time. Okay, and this appreciation in turn induced trade balance deficits that were substantial. Okay, appreciation, on the other hand, also reduced the cost of foreign borrowing once you express them in local currency, and this may explain the evolution of private debt that moved in opposite direction than the public debt. Okay, so as you can see, the private debt actually increased from 10% in 1975 external private debt to 40% in, this is a mistake, is 1982, okay? On the opposite, the public sector deficit went from 55% of GDP in 1975 to around 20% in 1982, okay? So both the private and the public sector debt, external debt, was moving in opposite directions, okay? Okay, and then since 82, okay, after the exchange rate was abandoned, the fixed exchange rate was abandoned, again, public external debt and private external debt moved in opposite directions, but for different reasons, okay? As it was mentioned, the private sector experience, or the private banking sector experienced a severe crisis, and it was somehow saved by the government, by the central bank and the treasury that took over the private debt, okay? So this increase in public debt is actually the debt that was acquired by the public sector in order to rescue the financial system. Okay, so in 1982 in June, the exchange rate regime was abandoned. There was the reason that, for this was that there were adverse international conditions, okay? Higher foreign interest rates and capital inflows that reversed, and domestic imbalances, or in this case, sorry, external imbalances could not be sustained any longer, okay? So in 1981, the current account deficit reached 14% of GDP, and that became, in this new environment, adverse environment, became unsustainable, okay? How can we understand this? With a very simple model, where we have this Krugman 1979 balance of payment model, which says that money demand, once you are fixing the exchange rate, the nominal exchange rate, will depend on the foreign interest rate, and money demand is equal to supply, which is equal to reserves plus domestic credit, okay, from the central bank, okay? An increase in Y star, which is the foreign interest rate, implied a monetary contraction, and in fact, we saw that reserves as a percentage of GDP went from 15 to 11%, okay? So part of the monetary contraction that Chile experienced was due to a declining level of reserves, okay, that were used to finance the current account deficit that Chile was experiencing at that time, okay? Overall, money rate of growth declined from 37% in 1980 to actually minus 30% in 1982. So actually money demand and supply, of course, declined as a consequence of this higher foreign interest rate, okay? So in this case, collapse was not due to an increase in domestic credit to the public sector to finance public deficits, but it was the fact that reserves could not sustain any longer the current account deficits of the private sector, okay? So in this case, perhaps the history of Chile is a bit different from other countries. The public sector was actually having, as I mentioned, was having surpluses and was having a very low level of public of external debt. Okay, so what was the consequence of this crisis for the future fiscal, monetary policy, and debt management policies? Okay, so part of the events during the crisis determine the way in which fiscal policy is conducted even until today, okay? So the fiscal burden of the crisis is important. In 1982, the sharp depreciation of the peso and the lack of international funds were basically the scenario that was faced by the economy and by the banks, the private banks, that most of them became insolvent, okay? Banks were not able to service its foreign debt, okay? And the government actually set up important rescue programs, okay? So once you read, again, the history of what the policymakers were thinking at that time, again, there is a consensus that they were not willing to default. The debt, according to them, should be paid in full, and that's the way in which they implemented this. That's the reason why they did implement this rescue program. Okay, that consisted basically on three things: bank liquidations, central bank buying portfolios of private banks, not performing portfolios of private banks, and providing foreign currency at subsidized prices. Okay. As a consequence of this rescue program, and well, as you can see, the central bank external debt increases substantially since 1983 onwards. Okay, and the debt was basically again another mistake. The red part is short, long term. Okay, so the debt was set in long terms. The legend here. The red part is long term. And okay, as a consequence of this rescue plan, the central bank kept very bad assets that were not giving any return, and was having or had liabilities that were very expensive, so to speak. Okay, so in '85, the operational losses of the central bank were nearly 20% of GDP. Okay. And in order to avoid problems for the central bank, the government, actually, the Treasury, issued debt or gave the bank a bond, okay, and which was an important amount, okay. And this bond, which is reflected here in this part, this is the public internal debt of the central government, and this part here is mainly the bond that was given to the central bank, okay? And the bond, in order to avoid liquidation of this bond or the inflation rate affecting the bond was actually set as an index bond, as what Marshall was mentioning, okay? So this is a UF denominated bond. It was changed in the at the end of the 80s to US, okay? But an important part of this public internal debt is debt of the Treasury with the central bank as a consequence of the central bank saving the private banks in the crisis. And it's and the maturity, and we know this maturity is 30 years, okay? So it's a very long bond, and it's 20% of GDP. Okay, so after that, it came a period, which is a long period, 20 years or even more, of fiscal discipline, okay? Chile avoided default, so Chile never entered the Brady program. The private banks somehow defaulted on the central bank and the Treasury, and this is a striking thing. I mean, some economists said, well, this was an explicit policy of the military regime, not to default. The fiscal adjustment, as we will see, it was huge, but of course, the government could resist the social pressures that came with this fiscal discipline. Okay, so Chile avoided default, and it was an explicit policy since the early 80s. Cost of the crisis assumed by the Treasury and the central bank, and debt position of the government worsened, increased. Okay, and to avoid monetization, public debt was indexed to inflation or was set in foreign currency. Also, there was long maturity of debt. For instance, in the case of this bond that was given to the bank, it was a 30-year bond. Okay. So the strategy was, as I said, since the late 80s to pay the debt, and to do that, you have to generate fiscal surpluses. Okay. So since 1987, well, even before, but since 1987, there is a clear policy of having surpluses, okay, public surpluses. And this public surplus, with the high price of copper, it was a very important proportion of GDP. So in the 90s, well, this policy of having surpluses was actually implemented through a rule, which was basically a fiscal policy rule. This is based on a yearly structural surplus of 1%, okay? And the net asset position of the government improved actually before this rule was implemented, okay? debt, external and domestic, was eventually paid. At some point in time, before the 2009 crisis, Chile was actually a creditor in the international markets. Okay, but this reduction in debt enabled the central bank to pursue independent monetary policy. Okay. So just to conclude, Chile experienced economic and political transformations since 1960 to 2010. In the early 70s, hyperinflation associated to fiscal deficits, stabilization in the early 80s through a fixed exchange rate policy, but this generated a severe balance of payment crisis that implied the abandonment of this exchange rate regime. The cause of the crisis was assumed by the central bank and the treasury, and the systematic policy that was implemented since 1987 until today was a policy of fiscal surpluses. As a consequence of this, the fiscal debt was reduced, and the inflation targeting policy could be implemented. Okay. So this is it. Thanks.
So I had actually written a paper on Ecuador. I've never written a paper on Chile, so but it was a great opportunity to go back and read some of this paper and some history and try to figure out some puzzles. But first of all, I want to say that I think this is a great project. As I understand this project, the idea is to apply some modern economic tools to understand better the fiscal and monetary history of the region. And as you know, the region's got such a history. It's a fantastic opportunity to do that, and maybe also we can learn something about the tools as well. So message to organizers, let's have the next event at the IDB, because I think this is a really great project, and we'd be very happy to talk to you about that sometime in the future. So Chile is a fascinating history, as we've heard. It's a real laboratory of stuff going on. Great plot, cast of many strong characters, and almost a Hollywood ending at the end. So, so it's really worth reading. I recommend reading this paper. And it shows, as Rodrigo has shown amply, the need to combine both the fiscal and the monetary history, not just the monetary, which I think was part of the idea of the project. So I learned a lot from this paper. I'll comment on a few things that the authors do, and also trying to be constructive about thinking about this paper going forward, what they don't do and maybe they might want to think about. I actually kind of wrote down 5 phases. I see you've aggregated them into 3. That's fine. 5's, one could make it into 12, I'm sure, but so Rodrigo didn't talk about the pre-period 1950, or you could go back, of course, to 1970 of import substitution. There was reasonable growth, but not great. Inflation was always an issue. Average inflation over this period of 30%, but increasing inefficiencies in the economy, some slow motion crises, and some periods of reform. And then we had the Allende period, democratic socialism, I've called it, expansion of government, increasing control in the economy and key industries, price controls, and as we've seen, monetary financing and inflation, hyperinflation. And then the first stabilization period, stabilization attempts post that, first more gradual and then deeper reforms, high growth in the 1970s, but increasing debt, boom in the non-tradables, financial liberalization, but weak supervision of the financial system. Then we have the devaluation in the early 80s and the financial crisis, the bailout of the financial sector, as we've heard, and then the need to generate fiscal surpluses. And then we get into a more stable period, 84 to 92, growth is high, fiscal surplus, but inflation is still around 20%, and there's improved financial regulations as is being discussed, but inflation is still relatively high. And so beginning in the early 90s, the idea of developing inflation targeting, at the start, both with exchange rate bands and inflation target bands, and then finally a more flexible exchange rate, coupled with fiscal rules, stabilization fund for copper, which was not mentioned, and a reduction eventually in public debt, leading to the almost Hollywood ending. That's my brief history. And so the authors use a set of tools to illustrate some of the things that are going on in those phases. Not really anything in that first phase, but in the second phase, they use essentially analysis of the budget, the government budget constraint, and as Rodrigo illustrated, how the argument could be made that the inflation was really a fiscal phenomena through monetary financing. Then they applied a Kagan model to inflation, especially during the hyperinflation period. And then leading up to the 82 crisis, they do, I don't think Rodrigo talked about this, but a kind of exchange rate simulation, counterfactual kind of exercise, and then they use the Krugman first generation model. And those are sort of the tools that they use in the paper. So on the first one, I mean, I think it's pretty convincing. In the paper, you not only look at the monetary financing, of course, but also debt, and there's debt in local currency, there's debt in foreign currency, and there's also index debt. Wasn't quite clear. I think this is more of an accounting exercise, but I think there was sort of question that perhaps was also my question is, what is the link between the returns on these instruments? I don't think anything's really imposed. What's the financing strategy of the government? Why was this monetary financing really there? There's a sort of offhand remark that the government's unable or unwilling to obtain debt financing, but that's not really brought out. So it'd be interesting to know what the rates were being paid on these instruments and if they were increasing, and if domestic currency instruments became unavailable and then there was a switch to dollars or indexed debt. This isn't really discussed. So I think that would be an interesting complement. I'm also interested if the budget deficits were sort of surprises and the monetary financing was ex post, if you see what I mean, rather than ex ante. That's not discussed. I think that would be useful. And there's this distinction between indexed and non-indexed debt, but it's sort of then in the equations, but it's not really commented on the text, and it's not clear to me whether that distinction is important in this period or not. I have a bit more to say on the Kagan model. You use basically current inflation. It's not clear to me what the assumptions are about the expectations from, well, it's clear what the assumptions are, I'm not sure whether they're valid, about how expectations are formed. It's not really discussed. And then I find this analysis very curious. I didn't know this paper by Mark Taylor and Kate Ficlatis, where they perform this sort of co-integration exercise. They test to see whether the series are I1, and they arbitrarily choose the period that they're going to do this over. There's actually a few papers out there that endogenously test what order of integration inflation series are. There are tests that one can use. There's a paper by Noriega and Ramon Francia from the Banco de Mexico. They go around, they actually look at inflation series all around the world and find endogenous breaks and test whether things are I0 or I1 or whatever. I actually have a paper where we also endogenously test for the order of integration of inflation, but we don't actually impose whether things are I0 or I1. Things can be fractionally integrated as well, so they can be close to I0 but not quite. So this is a graph from Noriega. Noriega and Ramon Francia, and these are the periods in Chile when inflation is found to be I0. So it's I0 here and it's I0 here, and so it's not I0 in the middle here, which is kind of, which would accord with your results. And this is from our paper. We find these three structural breaks. So between 71 and 80, something very odd could be going on, which is pretty much what you find. But neither of these papers look at what's going on in that period, as you do. Our interest is what's happening after 93. We want to characterize the inflationary process after the last regime change, as it were. But it's rather curious, I find it very curious, this technique. It's true what you say, if both series are are I1, then they could be co-integrated, of course, and then the residuals are stationary. But that it sort of implies then that this could kind of go on forever. This is like some stable equilibrium that could go on forever. But then you find that at some point you're on the right-hand side of the Laffer curve, and I think as your comment was, well, are the dynamics of this actually stable or not? It's not really clear to me. Of course, they don't have to be I1. They could be different order. They could be I2 or I3 and co-integrated. You don't actually show us the test statistics. They could be, it could be over time that thing is getting more and more integrated in some sense, and yet they still remain co-integrated, and you know, maybe that's, I hadn't really thought about that before, but maybe that's a way of thinking about an unstable dynamics even though you're in this co-integrating world. But anyway, I would recommend that you consider endogenous breaks. And there's some new techniques known as saturation techniques, which are very powerful for testing breaks of unknown dimensions at unknown times. So that might be useful to think about. Then leading up to the crisis in the early 80s, I suspect you kind of play down in the paper the role of the financial crisis itself, and I think that it probably has a much bigger role than the way it's described in the paper, in the sense that it's not just fiscal and money. There's actually things going on in the financial sector that probably deserve a bit more explanation. You know, there was financial liberalization, but supervision was very weak. There was already a comment about there was these relationships between conglomerates and industrial firms and the banks. There's all sorts of related lending going on. There was also an issue about the allocation of credit given the composition of GDP and how that was changing over this period. There was a big construction boom, non-tradable boom. So I think there are things going on in finance that are not, you know, not necessarily explained just by fiscal and money. In some sense, the crisis was much more costly, shall we say, than it would have been otherwise. So the punishment was worse than the crime if you just looked at the fiscal and the money, perhaps. And of course, you know, the lessons that were learned from that, as you mentioned, you know, very strong legislation was then passed about what banks had to do, and that they weren't allowed to do any of this related lending. And there was very, very strong legislation, not only in Chile, but in other countries in Latin America, which I think actually served then the region quite well going forward, and perhaps even helped us survive better the crisis in 2008, 2009, given this experience and, of course, the experience of the 1990s. And then it said, well, you know, as Rodrigo said, Chile avoided default like others in the region. Default is not an option, it says in the paper. Of course, that's to be applauded. But I wonder, and this might not be a very popular remark, but I wonder if that's actually an optimal strategy. It's stated in the paper almost as a moral statement, which seems a little odd because this is a paper, you know, applying economic tools to tell us things. So perhaps one ought to confront that moral statement with some economic tools and show that actually it was a good strategy not to default. There's an exercise I know that Guillermo did, Calvo, I think with Ernesto Talvi, if I remember correctly, comparing Argentina and Uruguay and showing basically the costs were more or less the same of either the country that defaulted or the country that didn't. But I don't know if that calculation has changed. But in other words, there was no gain. I mean, the way they say it is there's no gain from the default because obviously you have to pay a higher risk premium. But it would be interesting to do some sort of analysis. And then there's the period of the reduction in inflation and the eventual introduction of inflation targeting. And this is actually a fascinating period, but the paper just kind of finishes very abruptly. And you know, there's a lot, I mean, I understand there's quite a lot of literature already written on this period, so perhaps that was the reason why. But it is a really fascinating period. You know, inflation was still 25% in 1990 when the first inflation target band was announced for 1991. And as I mentioned, you know, there were exchange rate bands and inflation targets going on simultaneously. And the idea here, I think, was that even though the fiscal had been, the fiscal numbers had improved already quite substantially, still inflation was quite persistent, perhaps because of expectations. And so there was this idea that you needed to provide an explicit target to try to bring inflation down. And there does seem to be some evidence for that, and there's a few papers that sort of indicate that, I think. I actually have written a paper recently where what we do is we model inflation expectations as a function of lagged expectations and actual inflation. So the idea is to see whether inflation shocks, how inflation shocks affect inflation expectations. And Chile has quite good data on inflation expectations, so better than most countries. So you can do this. Actually, if you look at the whole period, both things are important. Both lagged expectations and actual inflation are important in explaining current expectations. But if you do a kind of rolling regression, you can see that in the case of Chile, the coefficient, this is the coefficient of how current inflation affects inflation expectations. It starts off almost significant, but then it sort of declines. And by the end of, if you include the whole sample, in recent times, it's almost zero. So in other words, there's almost no impact from inflation shocks today on 2-year ahead. These are 2-year ahead inflation expectations. This is not, for example, uniformly the case in Brazil, just as a comparator. So this, I think there is something to this argument that the inflation targeting regime has allowed, what helped inflation to come down, shall we say. That data was from an IDB database that we call Revela, where we grabbed the inflation expectation numbers from central banks in the region that have inflation targeting regimes. But actually, you guys have you must have access to the individual expectations. And there's actually quite a nice paper, I think it's by Wallace, looking at the disaggregated figures from the Bank of England. And you could do something like that. And I think that would be quite a nice complement in the last part of the paper. And it would probably go further than what we were able to do. So let me finish. There's sort of a bit of an obsession about just a few random comments to finish. There's a bit of an obsession in the paper with the net worth of the central bank. I've never entirely understood this, by the way. I think many central banks, if you look at their balance sheets, they're insolvent, but they still seem to be, they still seem to carry on. And I'm not sure that seigniorage, the present value of seigniorage is calculated and stuck in the balance sheet in an appropriate way. But I think of interest would be not just the net worth of the balance sheet, but also the size of the balance sheet and how that has changed over time. And in particular, there's this massive expansion because of the exit from the crisis. And then I think it would be really interesting to tell the story of how Chile tapered, so to speak. In other words, how those assets came off and liabilities came off the central bank balance sheet, which is missed if you just look at net worth. And then, I find this amongst Chileans. One of the really interesting things about Chile is just how indexed the economy still is. And how did indexation survive despite, its kind of role in leading up to the 1980s crisis? But it's still, was still prevalent today. And there's this interesting discussion why indexation, even though that experience, and why never dollarization, for example. And that's not really discussed very much in the paper. And then there's this curious, I find it still a puzzle why Chile hasn't nominalized, so to speak. Inflation's, if it's true that the inflation targeting system is very credible and so forth, still, every longer-term financial contract in Chile is in UF. So I'm still puzzled by that. It would be interesting to comment on that in the paper. Thank you. Stop there.
Right after sort of democracy came back, I thought that's when they had this agreement of having these sort of fiscal rules, right?
Yes.
Like,
it was
very close, or something more, but it wasn't so much on the Pinochet at the time, it was right after.
Okay. The explicit fiscal rule was adopted in 2001, but people who were at the government between 1990 and 2000, they claimed that there was an implicit rule that was followed. And people who were before, they were saying more or less the same.
It's noticeable in the data, the surplus is so bigger.
Yeah.
So given that, I'm thinking that the thought experiment, say that Venezuela and Argentina announce tomorrow, we're doing inflation targeting. We're going to copy the web page from the Bank of England, whatever it is replacing inflation targeting, whatever it means. We're just going to copy, we're going to announce the target, it's zero.
They also cite back here.
They could even say, maybe it's a bad idea. But let's take it as we will think, my guess is not going to work. So I'm trying to think about, there's something really kind of fundamental that did in Chile. So then I was thinking maybe it's just a different hypothesis. It's just more like like Nixon goes to China. So that, sort of, they kind of had to show something, some discipline, because they're sort of more looked at relative to Pinochet, that could do, he has no restraints from popular vote. So, you know, La Concertación, I think they had to show more, like a different, you know, like, again, like they need some constraints. So they had to sort of show more, they had to kind of overdo it a little bit on one dimension, relative to what was a government that is totally.
Say a little more Nixon in China.
Yeah, I think so. Like, the idea is that these guys were kind of like social democrats. That was the first couple of administrations. And I think they come after this sort of like government that is basically dictatorial, so it has no particular, they could do whatever.
That's like Tony Blair making the central
Exactly. Having to go more in one way to.
Yeah, more than.
So, whether that's, because I'm thinking like if Argentina were to announce inflation target or something, nobody would believe it. I think that they really did, the fact that you could write a rule in it, you know, how many countries like the US have these rules about the deficit? It must be some fundamental change. And I was thinking maybe it's that. I mean, people probably talk about it or something. Or maybe they think it's crazy.
Yeah, I mean, the answer has to do with something Andrew discussed. And you actually guess what happened. The democratic governments have to demonstrate that they were not going to do the same mistakes as before. Yeah. So actually, the central bank was given independence, was almost the last law that Pinochet passed. Yeah, and the central bank is still independent. So this law it's not changed, it's not even discussed now, and it wasn't discussed in the past either. So the way in which inflation targeting was implemented was in a gradual form. The government tried to convince first, the economic authorities of the other countries that they will do sensitive policies. And one policy is going to be to have a declining inflation level over time. That began at a level of 27% in 1990. Next year, the target was 20, and so on. So the target was always hit, and sometimes underhit. But it was a gradual process of regaining some confidence. So that's the way in which it was done.
Okay, then we have two. One is, in the end, I was confused by the crisis in 82. I thought that it was a textbook Krugman balance of payment crisis. I never seen the data. There's the risk of looking at the data as you're doing. Yeah. So you're telling it's not that. What is it?
Yes, I mean, we also thought the same. We saw the data, and actually what happened is that reserves declined, actually as Krugman predicted, but for different reasons, we guess. So in Krugman model, the standard one, money supply is fixed. So if domestic credit increases, then reserves decline, and if you reach a minimum level of reserves, then you bust, basically. In this case, domestic credit, reserves decline, and the monetary base contract, but because you have a higher interest rate, foreign interest rate, no? So the constant money supply is not valid any longer once you have a higher foreign interest rate, you know? It has to contract. It has to, if you're fixing the exchange rate, it has to,
yeah. So, but it's the same. Instead of being that because you accumulate the loss of reserves because the funds in the private sector, you have an increase on the foreign interest rate.
Yeah, and you have to contract the monetary base, one way or the other, I mean.
That's not special to Chile. He's claiming that we shouldn't need the whole 81, 82 thing. That was the Volcker contraction.
Yeah.
Okay. And well, people say that. I mean, that's not.
That doesn't make it.
The other thing was also related to something that Friedman commented on his referee report, which is, I mean, this comparison of the end of big inflations and the end of moderate ones. And there is this notion that we have Argentina and Venezuela that eventually, hopefully, will not get beyond 50%, 60% of what they might. And then eventually they try to go back to zero. And there is this notion that you can only do it gradually. And happens in Chile daily, right?
Yeah.
But was there a discussion at the time? Was the obvious reasons why they chose that instead of?
Oh, okay. The reasons they chose a global policy, both in the mid 70s and in the 90s, was
The
the
90s.
in the 90s. Okay. Okay, was the fear that the economy will contract too much, and that the indexation that was going on at that time, which was more than today, and today is still a great degree of indexation, was too much to induce a credible.
So this is some sticky price story.
Yes, sticky price, a monetary policy trade-off that will imply a contraction in the output gap. So that was the vision at the time.
Anything else? Coffee time then, I guess.